With all of the incoming U.S. macroeconomic data, news headlines blaring, and economist opinions galore, there still seems to be no basic, formal, logical framework available on how to visualize our current economic situation. Our chief equity strategist and economist, John Blank, has input on all of this, and he's here with me now. John, you wrote that earlier this month in your economic outlook, what I just kind of iterated there, and I paraphrased it a bit, but what does all of that mean?
Well, Terry, if you go to what's called the Federal Reserve of St. Louis, FRED, the FRED database online, and you should just Google it or go to it in the web page, you'll find that this is where the Federal Reserve System itself collects all of its data and some of the data across the government outside the Federal Reserve System. That is macroeconomic. And they have done something called a macroeconomic snapshot. And you can click on that if you can find it. It's not that hard. Again, just go to the search tab in their website and do it. But this will actually give you the standard, 6 or 8 charts you need to understand the U.S. macroeconomy and be updated for you, put together in a time series, colorful, everything perfect.
So you said in your commentary on Zacks.com that you have 2 inputs to lift the confusion on our economy. What are they?
Well, that's it, Terry. That is the basic idea here is you can go to these macro snapshot charts and update yourself on the economy. So that is basically the idea of what I think people should do. And it's really, the second one is just to kind of lay out the framework of how these things fit together. And really, it is just supply and demand. But in the macroeconomic framework, it's income equals production. And then further down the line, it's income equals domestic production and foreign production. And people don't understand today, particularly today, gross domestic product. Often we talk about it really quickly as just production, but it's actually domestic production, gross domestic product. We have to add on the trade accounts to that.
So what are these inputs actually currently saying about our economy?
Well, this is what's interesting. The gross domestic income, which most people don't even know exists, but is actually, the amount of income available to people, has been above trend the last year. That is causing all the pressure and also keeping the job openings so high. There's just a lot of income out there after the COVID pandemic. Raised savings and all the stimulus came into people's hands. And frankly, people just have, benefited from all the liquidity in the markets for stocks. So on the other end of that, gross domestic product has been lagging. It has been basically negative, probably will be negative in the third quarter too, or very flat. But between that is a huge rising trade deficit. So that's the port story. That's the shipping in from China. So much of the goods haven't been served, the goods from the income that was excessive through the ports. So that's what people need to understand is it's thinking about it now after COVID, where income and production domestically don't net out. You got to have an understanding of that very basic concept to know why things are still robust and inflation's rising because incomes are high, but even though domestic production is sideways.
And are these inputs the deciding factor on how high the Fed hikes rates?
They are the formulation behind the price levels. And what I tell people all the time is the actual price level that corresponds to these GDP counts is called the core personal consumption expenditure, PCE, which is the C inside of CI and G that domestic production gets broken out into. So what happens here is that is now at 4.7% this morning, which is up from 4.6 last month, even though people think and are right that food and energy costs are going down now, the port things are easing. All the Fed will care about within this structure, which we're talking about, which is what managed their Fed fund rate, is actually it went up 1/10 of a point. 4.7 means that we can get, if you add 1% on top of that for a 1% real rate, the Fed actually, without the core PCE falling, is going to go to 5.7% on the Fed funds rate next year.
And how does the latest CPI data factor into all of this?
Yeah, this is interesting. And people, I get people thinking, and we read a lot about the consumer price index. This is for the labor markets. It's for, it comes for people who are making decisions about Social Security, cost of living adjustments. And actually, this is the consumer price index, if you just think about the language. So it's really the price index that's available to a given consumer versus consumption, which is a broad term for all, production spending that's consumer related in the U.S. economy. So what happened is, over time, people who are on, getting incomes from Social Security and other fixed payments were not finding that things were tying out. So the labor market people at the Bureau of Labor Statistics took it upon themselves to create the consumer price index that is always much higher and more volatile than the personal consumption expenditure index, because it's not actually as macroeconomic. It's a more narrowed, focused index.
So has any of what we've discussed here changed your outlook for the GDP going forward?
No, I think GDP is going to continue to stagnate because it is continuing to be the case, particularly through the foreign exchange markets where the dollar is so strong. As we get stronger and stronger dollars, you can still buy your production abroad cheaper and cheaper. So that is sucking the growth from the income side of the equation, is delivering into the trade accounts and away from domestic production. So I think the answer is we're going to still keep going sideways with gross domestic product. That's not going to be a recessionary signal.
Globally, other major central banks around the world are hiking their interest rates also to address their inflation issues. This as the UK has a new leader. Italy even has a new prime minister-elect just recently. So for Europe, energy costs are a big issue as well as for the U.S. Will the Eurozone and the UK topple into a recession due to soaring energy costs?
I think the answer most definitely is yes. I don't think they can escape it, other than like what we've talked about for subsidies that add to income within their countries from the government. So the only way you can do it is actually manufacture incomes for people for the next year, and hopefully that the war ends up on the side of victory, within 6 to 9 months. But thinking that Putin's going to get more desperate and more restrictive to Europe for energy as a source of negotiating leverage, very hard to see that going anywhere but worse. And that means Europe's got a real issue for itself. And it's very, very hard not to see Europe go into recession.
And as far as individuals wanting to stay on top of this macroeconomic data and trends, that Fred website that you mentioned earlier, is that the place to go?
Right. You go to the Federal Reserve Economic, the St. Louis Fed, FRED, and you go to the Macroeconomic Snapshot. That is what they have available for you.
Okay. A few strong buy stocks on your radar include Arista Networks, Albemarle, and ST Microelectronics.
Yeah, Arista Networks, ticker ANET. This is the number one ranked stock. However, it's got a D for value and a D for growth. What it is, it's in the communication components business. It's out in Santa Clara, so this is like a cloud computing, networking, data center type equipment. So yeah, it's out of favor right now. This is one of those high beta stocks, 1.3, that people don't like right now, but they're going to like them as soon as the market turns around. So watch Arista, maybe not invest in Arista. Albemarle has the chemicals for these batteries. This is the number one ranked stock, but terrible value score of F, terrible growth score of F. Stock's going up, though, because of the story here. This actually is a high beta stock that's getting a bid because of its special niche business. So you got to like Albemarle for nothing other than to understand its business as a specialty chemical company in the attractive markets globally. The other one I want to point out is ST Micro. Again, the chips are out of favor, but this stock actually is a number 2 ranked stock. And here's those style scores that are much more attractive. A for value, A for growth, A for momentum. This is a 1.55 beta stock, ST Micro, sold off nicely, probably selling off big today. I got it down actually 6%. So you got to say to yourself, as a long-term investor, who would be crazy not to pick up STM? That's what our quantitative system, long-term ranking system is telling you is absolute perfect three A's. So I'm putting a huge bid on ST Micro today as a contrarian.
Okay, and I'll apologize to our listeners for my mispronunciation of Albemarle. Meantime, our chief equity strategist and economist John Blank with me talking about the economic picture in light of macroeconomic data, trying to break it all down for you. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.